in the past 6 weeks, nothing has actually fundamentally explained why crypto should be underperforming risk assets. Because the S&P, of course, has had a drawdown, but the S&P continued to rise for another 20 days. The S&P didn't peak till the 29th. So that divergence has to reflect either a change in how market function in crypto, or was there an existential new risk? Now, that could be someone's simply saying there was just too much leverage. That's why leverage is hitting crypto harder. I mean, that's a possible explanation. But to me, again, especially working with DeMark team, I think that there is something that is causing a lot continued leaking, but we're close to the end of that leaking.
Over the past 6 weeks, the crypto market has tested investors in a way that feels both familiar and strangely disconnected from reality. Prices have bled lower even as equities held up. Leverage has collapsed, and yet, none of the usual explanations truly account for what we've seen. That's exactly where Tom Lee steps in. Lee has spent decades analyzing market structure, liquidity cycles, and the psychology of price discovery. And in this conversation, he argues that crypto's recent behavior isn't the result of some hidden existential threat. Instead, he points to something far more structural, something happening beneath the surface that the market hasn't fully processed yet. In his latest interview, Tom breaks down why the divergence between the S&P 500 and crypto isn't about fundamentals, isn't about quantum risk, and might simply be the aftermath of one violent liquidation event that flushed out an entire wave of retail participants. But more importantly, he explains why that kind of selling eventually ends, and why we may be closer to that point than most people realize. As you listen, think about this. If the last seller has already sold, what does that mean for the next phase of this market? And what comes after a forced reset of leverage? Stick around, because later in the video, Tom lays out a detailed thesis about tokenization, Ethereum's supercycle, and the institutional flows that are quietly reshaping the landscape. Before we dive deeper, make sure to hit the like button, subscribe, and tell me in the comments whether you think this recent drawdown is leverage-driven or structural.
For the listeners, in 1971 was when the U.S. formally withdrew from the gold standard, meaning the dollar was no longer redeemable for gold. And from that point forward, the U.S. and other countries, not every country went off the gold standard, basically said that from this point forward, a dollar is only exchangeable for another dollar. Okay, so the dollar became essentially synthetic relative to gold. And in 1971, many investors correctly bought gold because they said, well, that's the original store value. However, the second reality is that we had to suddenly protect the dollar to make sure it was going to be the world's reserve currency, because if that was no longer exchangeable for gold, then a country that was still in the gold standard could become the new reserve currency. So what happened? Wall Street built a bunch of new products to make sure that the dollar became the accepted standard. And over that ensuing 10-year period, it was money market funds were created, CDs, futures, ETFs, and it was successful because the dollar remained the global reserve currency. And today, it's now 80% of all financial trading pairs. In 2025, there is a similar evolution taking place, and it really started with stablecoins, which is that the dollar, which was already now synthetic, became tokenized on the blockchain. So now the dollar is now digitally represented. And that's what a stablecoin is, because it's backed by treasuries, but it's still basically just a digital dollar. That is going to be creating the roadmap for a lot of other assets to become digital, tokenized on a blockchain. And it's a big deal. We know that in crypto, for instance, the projects that have actually emerged from as native blockchain products have actually been better mousetraps. And that's something that is driving and sending Wall Street to build. The first of these has been the stablecoin and Tether. And Tether, as an entity now, it's valued, and they're raising at what is reported to be $500 billion. That would make it the second most valuable bank in the world. And even if it ends up being raising at 400 billion or 300, whatever that number is, they're still the second most valuable bank in the world after JP Morgan, which is 869 billion. So a company that has today maybe 300 full-time equivalent employees is almost as valuable as a bank like JP Morgan has 313,000 employees. So there's a lot happening. There's a lot of benefits that come from tokenization, and I think that that's the big unlock that's coming. When something becomes native digital, it works really well. There's many examples. For instance, crypto trading 24/7 is an example, but look at how we do all communications. It is all native digital now. Emails are digital, or, messaging. And in fact, over the last 10 years, I think it's a low estimate to say that at least 50% of all GDP growth in the last 10 years is native digital. It's probably now close to 60%. In the next 10 years, it's probably going to be 70%. So increasingly, almost all innovation and growth is native digital. And yet we're using geographically defined currencies, and we're trading instruments only 5 days a week with specific market hours, even though during those market hours, 99% of all the trading is already electronic anyways. I think one of the challenges as we tokenize is, of course, going to be making sure there's still the same liquidity that's available, because we know one of the glitches in crypto is liquidity is not universal. And so we do want to make sure prices are correctly reflecting a deep and full market whenever we see a price posted. But that's, of course, software. Someone can define prices correct or put limits on price change if necessary.
Yeah. All right, so let's talk about Ethereum. You've talked about Ethereum entering a super cycle. You talk about stablecoins, as we mentioned, being that chat GPT moment. You've made a 60K call on ETH. But right now, the market seems to be thinking about things differently. Why are we trading as we're trading right now with Ethereum?
Well, Ethereum and Bitcoin are public tokens. And so their price isn't going to be purely anchored on fundamentals. They're going to be reflecting investors' perceptions, because both Bitcoin and Ethereum are not mature platforms. Their best utility and growth and innovation are in the years ahead, right? So we're 10 years in, but there's more growth in the future. The percentage of market share of crypto of total assets is so small that we know that mathematically that's true. Whenever when you have something that has a hyper growth on ramp and you're discounting the future, it's going to be very volatile. So does Ethereum's price going from 4,800 to 2,800, that is a staggering decline, but that probably is a minor change in 2030 fundamentals that is being priced and repriced by investors. And that's why there's hyper volatility. It's one reason why BitMine ended up engaging Tom DeMark as a strategic advisor, because he is the king of sort of price discovery. He is the father of systematic timing. And in our conversations, when he looks at Ethereum, he sees what looks like engineered or systematic liquidation taking place. So there is someone that is in crypto, we know it's, market makers play a big role, but there's someone that is probably capital constrained and is therefore bleeding or having to sell reflexively as price falls. That process is painful, but in his sort of rough timing range, his downside target, and we talked about this a few weeks ago, was 2,500 for ETH. So I think we're so close to that. It would be ideal actually for us to actually bleed to that level, because then that is creating what he calls a buy setup. A bottom in prices for him is when the last seller has sold, so that a stock or crypto no longer falls on bad news. That's what he thinks makes a bottom. So it would, I think, be a better situation to see crypto prices bleed lower to 2,500. But it could reverse at any time, because markets don't have to do what ends up being an ideal scenario.
What Tom is describing isn't just a moment of weakness in crypto. It's the typical pattern we see at the end of every deleveraging cycle. Retail gets hit first, overextended traders get wiped out, liquidity dries up temporarily, and price begins to behave in a way that looks irrational until the underlying exhaustion finally clears. And that's exactly why the next section of this conversation matters so much. Because while the headlines have focused on price drops, Tom argues that the real story of 2025 has nothing to do with short-term volatility and everything to do with a structural shift similar to what happened in 1971 when the US abandoned the gold standard. This isn't hyperbole. Tom believes we're witnessing the birth of a new monetary framework, one where the dollar isn't just synthetic relative to gold, but fully tokenized, accessible 24/7, and capable of being integrated into every layer of global finance. And if the transition from gold-backed money to synthetic dollars created an explosion of financial innovation, Tom argues the tokenization of dollars on blockchains is going to be exponentially larger. In the next segment, you'll hear Tom break down exactly why tokenization is accelerating, why Ethereum sits at the center of this shift, and why the coming institutional phase may look nothing like the retail-driven cycles we've lived through over the past decade. His explanation ties everything together: the recent volatility, the exhaustion of leverage, and the larger technological transition that is already underway.
I mean, I'd say if someone wanted to say, why did crypto diverge from equities?
Yeah.
That's, I think, a big role, because in the past 6 weeks, nothing has actually fundamentally explained why crypto should be underperforming risk assets. Because the S&P, of course, has had a drawdown, but the S&P continued to rise for another 20 days. The S&P didn't peak till the 29th. So that divergence has to reflect either a change in how market function in crypto, or was there an existential new risk? I mean, the only new existential risk would be like if quantum innovations came along, but there hasn't been that.
You think it's existential or just idiosyncratic? I mean, nothing seems existential here to me.
Well, I mean, Chris, the one thing that I would say that maybe isn't reflected in price is the number of account holders that got wiped out on October 10th. And I think we may not even hear from them because they've been liquidated. To me, that's probably, now that could be someone's simply saying there was just too much leverage. That's why leverage is hitting crypto harder. I mean, that's a possible explanation. But to me, again, especially working with DeMark team, I think that there is something that is causing a lot continued leaking, but we're close to the end of that leaking.
How do you tell the Ethereum story, and how has it evolved, as you started to have these conversations?
Well, I think you're spot on, Chris. Like when someone says, what is Bitcoin? I think everyone really accepts it as it's a store of value, a really good way to store value. And that's accepted today. In fact, someone might say that's like a Lindy effect, that people believe that. When we first started writing about Bitcoin in 2017, and digital gold was one way to sort of argue Bitcoin's value, it was not accepted because many people said, well, come on, I mean, it's just code. I mean, how can code store value? Or why can't there be 100 Bitcoins? Or look, I could create a new Bitcoin tomorrow, or I could fork Bitcoin and create a new Bitcoin, or I remember one client saying they couldn't buy a bottle of water with Bitcoin, so how could it even be valuable? So, but of course, all those arguments fell away. And now we have digital gold, Bitcoin, store of value. Even as gold gets tokenized, which I think will compete with Bitcoin to an extent, you still have Bitcoin, which is a really good way to store and transfer value. But Wall Street is also understanding there are a lot of virtues to a blockchain, and it's the ability to not only store value, but to store information and to actually transact and conduct and actually re-architect almost everything that Wall Street does, but they need a smart contract platform. And so that's where all these other L1s start to become a lot more important to Wall Street's future. Because if the the big banks, the blue chips, build stable coins, and they're going to tokenize stocks and let stocks trade 24/7, and then innovate that too, which I discussed at the Cantor, which is like things like factorize a stock. So no, just like in the bond market where you can factor a bond, we can factor Tesla so that you're only buying the implied future value of Optimus Prime. So instead of asking Tesla to make itself a tracking stock, you can synthetically create that on the blockchain. So you can't really do that on Bitcoin. So you have to build it on a smart contract, L1 or L2. And the reason I think Ethereum is going to be one of the leading platforms is, number one, its sheer size. It is by far much bigger than the number 2 or number 3 L1s. It has a huge and growing developer community that is really dedicated, and it's global. So I think it's a true, robust community with actual known values. And it's a neutral blockchain with 100% uptime. So I think that this becomes one place where it's going to be easier for people to create innovative products. So for instance, let's say JP Morgan or Goldman want to just do tokenized stocks in 24/7. And they want to control as much of that as they want, as they can on a blockchain, because you lose a bit of control. They may not necessarily say they want to do a lot of this on Ethereum, but then someone's going to come along and create a product that does do this, and it's supported by a community, and then it gathers all the liquidity. That's exactly what happened with something like Polymarket, right? On a prediction market basis, where it came natively out of the blockchain and today broke out into the real world and it's the most cited way to actually understand events in the future. I mean, it's the Polymarket is the closest to having a crystal ball today. Like it is the closest to tomorrow's newspaper, and it's a native blockchain product. It didn't come out of an existing Wall Street desk that created this product. It was created by builders. So that's why I think Ethereum, and it doesn't have to be only Ethereum succeeding. I think Ethereum, there will be room for others, but I can see the clearest roadmap for Ethereum succeeding.
As Tom lays out here, the turbulence we've seen isn't a sign of crypto breaking. It's a sign of a market transitioning from being retail-dominated to institutionally driven. The flipping he describes isn't Ethereum surpassing Bitcoin's market cap. It's the moment when large, liquid, long-horizon players begin replacing short-term speculative flows. And when that shift happens, fundamentals matter again. Utility matters again. And platforms that can support tokenized assets, smart contracts, and 24/7 global liquidity suddenly become the backbone of everything that comes next. Tom's view of Ethereum reflects that logic. The volatility we're seeing now isn't a collapse in fundamentals. It's simply the market repricing the future during a period of forced selling. And when you zoom out, the timeline matches every previous adoption cycle. Bitcoin needed a decade before institutions took it seriously. Ethereum is now passing that same threshold, but with a far broader set of use cases, a global pool of developers, and a role that extends far beyond being digital gold. Tom's core argument is simple. As Wall Street moves deeper into tokenized assets, stocks, treasuries, corporate bonds, even structured products, they will need a neutral, secure, always online smart contract platform. And Ethereum is the largest, most battle-tested, and most widely supported option. When you combine that with institutional flows returning, tokenization accelerating, and the historical pattern of bottoms forming when the last forced seller capitulates, the setup Tom is describing is far more constructive than the last few weeks of price action would suggest. So the real question is this. If we are witnessing the final phase of structural selling and institutions are positioning for the next decade of digital finance, how will you position yourself for what comes next? Let me know your take in the comments. Smash the like button if this breakdown helped clarify Tom Lee's thesis, and make sure to subscribe for more in-depth analysis. Thanks for watching, and see you in the next one.